Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Building with Intentionality, growing a $1 billion business to a $4 billion enterprise and beyond. It's a conversation with Mike Quin, managing partner of DayMark Wealth Partners. I'm Louis Diamond, and this is the Diamond Podcast for Financial Advisors.
At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade, and each year, 25% of transitioning advisors who manage $1 billion or more are our clients. If you'd like to talk, please feel free to give us a call at 908-879-1002. Are you a financial advisor who's curious about whether you're in the best place to serve clients, or if there might be a better way to optimize your business for the future? Should I Stay or Should I Go is a new book that serves as a self-guided journey, walking you through the key steps that Diamond Consultants takes with our advisor clients, whether considering change or not. Visit diamond-consultants.com/thebook to learn more.
Most think that the breakaway movement is driven by advisors attracted to the premise of being an entrepreneur and building the business of their dreams. No doubt that's true, but there's also a trend of some of the biggest and brightest leaders in the industry who are equally motivated to execute their vision beyond the hollowed walls where they hone their leadership skills. Mike Quin's 26 years in the industry, for example, was primarily in senior leadership roles at Morgan Stanley, UBS, and most recently, Wells Fargo Advisors as the Ohio market manager, where he was recognized as a premier manager each year. In Mike's view, his role was to work with financial advisors and their clients. Yet over time, he felt the big firms were changing their perspective on the client side. So like many returning to the office after COVID, Mike and his advisor friends who ran their own practices at Wells found themselves thinking about the value they received from their firm and whether they could fully serve clients with impunity. In this episode, Mike shares how he and his team got together to create DayMark Wealth Partners and their vision for the future. He talks about his journey and how it guides his future. Mike explains how recruiting the right talent has driven extraordinary growth and the unique value they bring to advisors who join them. Plus, he shares the vision he has in serving clients and the importance of ensuring that they stay true to them and much more. So let's get to it. Why don't we start off, if you can just share with us your background and how you found your way into the industry to begin with.
Sure. I was born and raised in New England and went to college in Ohio. After college, I worked for a healthcare company, and we supplied pharmaceuticals to large hospital systems pharmacies, which led me to quickly realize I wanted to build something versus work for someone else's plan on an annual basis. And that led me to our industry. Like many people, I think I followed the path down the road of the financial services industry for a couple of reasons. One was you could start your own business under an umbrella without having to put in capital. Your capital became your sweat equity. I think the second probably was the job was actually accretive to people. It put you in a position to help people. And third, there wasn't a ceiling on earnings. Certainly at that time, you didn't make a lot of money starting out, but the idea of building it over time was there, and it could be a successful endeavor. And finally, I think really the business was and still is competitive, and I really like that.
Yeah, I like what you said. I haven't heard the perspective about you don't need seed capital or startup capital to start a business in this industry. It's more your own sweat equity. And I often say that even advisors who are breaking away, they're starting a business for the first time. They have many advantages to any other entrepreneur in another industry who doesn't have proof of concept, doesn't have relatively immediate revenue, and doesn't have infrastructure that they could plug into for relatively cheap costs. So I like that perspective a lot. So it sounds like you started off as an advisor, but then at what point did you decide to become a manager at UBS?
Yeah, I did. I was an advisor, started an advisor at Payne Weber originally, and then a very good friend of mine, I would say, guided me towards management. I was young and having moderate success as an advisor, but like the idea of leading people and leading the organization locally. And so, for better or for worse, jumped into the management training program a few years in after becoming an advisor.
Any regrets now or then about dropping your book of business and joining the management ranks?
I wouldn't say regrets. I mean, it's been a great run on this side of the fence. Certainly, the running joke in the business is that you would never give up a book of business to go into management, but I found the management job rewarding in many regards, and I wouldn't trade it.
Yeah. Let's talk a little bit about your managerial path that ultimately led you to launch DayMark a few years ago. But you mentioned you were an advisor at Payne Weber, became a manager at UBS, and then I believe you moved to Morgan Stanley and to Wells Fargo Advisors. So can you talk a bit about why you moved between firms and what was it that attracted you to each firm as you made your own big leap?
Sure, yeah, I'd be happy to take a trip down memory lane with you. Yeah, I think first, so Payne Weber was acquired by UBS. That was a big deal at the time. Obviously, they're a Swiss-owned entity. And really, the move to Morgan Stanley for me wasn't based necessarily on what the firm was doing as much as it was on my family making a decision to move geographically. We were, at the time, with UBS in Fairfield County, Connecticut, and my wife and I made a decision that we really wanted to raise our family, which consisted of 3 young children at the time back in the Midwest. And so Morgan Stanley offered me a position in Cincinnati, Ohio at that point. The move to Morgan Stanley was exciting. It was a firm with about 7,000 FAs, I believe, at the time, and a focus on driving towards the wealth management business from where they were. Also, at the same period of time, the world started to change under our feet. That was 2008. So the financial crisis hit. Morgan changed their iteration over several months during that time and eventually acquired Smith Barney, which had an incredible private client business. And we sat and we grew that in Ohio for several years. Directionally, the firm started to change as it grew up. It obviously wasn't the same firm that it was when I went there. And I think where they were going for me caused me to evaluate my beliefs, what I was good at, what I wanted to do from a management perspective going forward. And that's when I started to look at more of what I considered to be an entrepreneurial route. Obviously, Morgan Stanley was incredibly successful. I still have a lot of friends there. But in 2013, I went to Wells Fargo Advisors. At the time, David Koach was running the firm. And I believe that the leadership was running that organization from the FA, which was attractive to me in the management seat.
Very interesting. And you rose through the ranks within Wells, had some very senior roles. So obviously, one option you had in front of you was just to keep climbing the corporate ladder and go to the next rung up. Or, of course, you probably could have gone back to one of the wirehouses, and you're one of the top recruiters I've worked with. So I'm sure your services were in high demand. So I want to talk a little bit about the mindset of wanting to leave the comforts of a big salary and big title and stability to take the entrepreneurial route. We'll spend the rest of the episode talking about DayMark and the launch of it, but maybe let's start there, just the mindset and thoughts behind becoming a business owner.
Sure. When I sat in the seat, my view was that I worked for the financial advisors and their clients. And directionally, as I mentioned, some of the larger wires, now the banks, started moving away from that model, in my opinion. And while it was a very good run, I believe that clients still turn on our lights and that we should serve them and only them. And so when we started to look out across the landscape as to where to land and how to stay true to our beliefs and what we thought was most important, which was the clients, that led away from where I had been my whole career and toward really building something and creating something on our own.
As we're recording this, there'll probably be more if we had this conversation a year from now, but just a couple of recent examples of very senior leaders from wirehouses moving into the independent space rather than I guess, moving lateral. If you look at people like Jim Dixon and Vince Fertitta, or John Thiel just announced he's doing something, Jim Gold of Stewart Partners, Dave Koach, who you mentioned, of And Partners, Greg Fleming of Rockefeller, the list goes on and on. Why do you think we're seeing more folks like you do this?
Yeah, it's a good question. I can't speak for others as far as their motivation goes, but I can tell you when I sat in the seat, my belief was that I worked for financial advisors and clients. And so directionally, as I mentioned, the banks and wires were moving away from that, in my opinion. And that gave me pause to really want to move back towards working directly for advisors and clients. And I think that all the people you've mentioned have grown up in this industry and certainly seen it evolve rapidly over time. Those organizations started out as partnerships, and they've all rolled up into several banks that are left on that side of the business. And so when I think about the leaders you're talking about, the ones I know personally, most of them sit with that same set of beliefs that it starts and ends with the client and advisors. And I think the space that we're all playing in now gives us the opportunity to create that in our own belief system.
Well said. Also, a big part of it is likely folks like the ones I mentioned, and you know what you're good at. And ultimately, what it takes to run a successful enterprise in the independent space, it starts and ends with being able to attract like-minded teams. So if you're one of these big executives who has a following, who knows they have loyalty, they have great relationships with advisors, it's like, may as well build something where we actually own the equity, we can monetize it down the line, and we have control over our own destinies. But I think a big key is being good at recruiting, because ultimately you can have the best brand, the best platform, the best managers, but if there's no advisors to fill the seats, the business doesn't really take off. So I think it's a credit to you as well. You've been a prolific recruiter, bringing in some of the biggest teams to the firms you've been at. And I know you have a very quick head start with DayMark, with already having some success, which we'll talk about.
I appreciate that.
Yeah. So I think what's really interesting and different about the founding of DayMark is how you came together. Because like we were talking about earlier, you didn't have a book of business at the time, but the firm launched with over $1 billion in assets. So can you talk a little bit about the founding members of DayMark and how you all came together?
Sure, yeah. I would probably qualify it as an organic process. The group that launched DayMark and I were friends both in and out of the office. We spent time together on the golf course and in other areas of our lives. And at some point along the way, it became evident that everyone was evaluating options. And I think part of that was coming out of COVID. Part of it was getting back into the office and evaluating where the value lies. But when it became evident that everyone was evaluating options, we decided to join forces in the due diligence process first, share what was learned. And then later in that process, it became clear to us that our best and most exciting option, for a lot of reasons, would be to launch our own firm.
So it wasn't that you partnered with a team. I believe it was multiple different advisors who each had their own practices. Is that right?
Yeah, that's absolutely right. All the partners had their own practices, and there was me obviously in that mix. And again, as I mentioned, we were close. We worked together closely for a decade and started to share kind of our experiences out in the marketplace.
It's an interesting concept because now a new trend we're seeing in the space is the power of aggregation, whether it's roll-ups that offer a major liquidity event at the end of the rainbow, or we hear from many advisors who want to come together because it'll enhance valuation, it'll give them scale, et cetera, but it's really hard to pull off. So I'm curious, like, I know you probably don't want to speak to the motivations of your partners, but I'm sure part of what each individual practice was thinking was, why don't I just go independent, whether through FiNet or do it on my own? I'll own 100% of my own equity, have complete control over what happens versus tying up with other folks. So I'm curious about that dynamic, about individually going at this problem versus the mindset of coming together.
I think what happens when we were all doing due diligence on our own, and when you start to have that conversation amongst people you trust and value their opinion, it bubbles up things to the surface that you necessarily wouldn't think about by yourself. And while what you said, I think is accurate, everybody was looking at all the options, certainly for themselves, their clients, and their practices. Learning the space together away from the traditional brokerage firms was an exercise that I think caused a bunch of growth. And for us to look at the business in the future, really, probably collectively, which we wouldn't have done if we had never come together to talk about it. I think there's a couple different ways to go independent. You mentioned a few of them, and I'm sure we'll get into it, but there is no doubt that in business in general, scale helps.
I think another different part of DayMark and the founding is that you, Mike Quin, without a book of business, became the CEO. And it's very rare. I can't think of really many other examples of breakaway teams partnering with or hiring a professional CEO who doesn't have a book of business to lead the firm. Usually it's the largest producer or the founder of the team that just becomes the de facto CEO, either by default or because they deserve it. But it's rare that a breakaway team will invest in professional leadership like yourself. So Why do you think your skill set and in general, just taking it away from DayMark, that a breakaway team might be advantaged to invest in professional leadership from the jump rather than waiting 10 years and they're accidentally successful like many are?
Yeah, another good question, Lewis. I have a couple thoughts there. First, I think that the business in the RIA space has evolved fairly rapidly over the last, call it 5 years. And I think it depends on what type of business you're trying to create in this space. So if the goal is to set up a lifestyle business, move your current business, grow when you can, and be the full business owner, I don't think that the skill set of a professional manager is as important. But however, if the goal is to scale and become a recognized platform firm in the space, then I believe a diverse skill set helps drive that. And when you get into it with a group of partners that we all have unique skills across the investment landscape, deep expertise across client segments. I've obviously got experience across the country in talent acquisition. And so I think having professional management allows for everyone to contribute what they are great at to the partnership while growing the value of the enterprise. It allows us to stay cutting edge modern. It allows them to develop in their lanes and then relies on me as one of the partners to go out and scale the business. So I do think it depends on your perspective and what you're trying to accomplish longer term. And the partnership at DayMark is very interested in continuing to grow our platform firm presence and grow rapidly. So we've got some pretty aggressive goals.
Yeah, I think that's exactly right. I think most breakaway teams, they may say at some point, we want to acquire businesses. We want to recruit like-minded advisors. We'd love to build an enterprise. But I think few take the actual steps necessary to turn that cocktail napkin plan into reality. And I'm completely with you that if you know you want to be a destination for advisors and not just one or two friends, but to make it more of a national presence, no lead advisor has time to really allocate to building it in that way. So I think whether it's upfront like DayMark did or before you're ready for prime time, you need to think about ways to free yourself up, because courting advisors, running a business, dealing with access to capital, other things like that, it's a full-time job. And if you really want to build a platform that's scalable and that is a place that other advisors want to call home, I'm completely with you that investing in the firm like DayMark did is a requirement.
Yeah, I think that's right. I think we are like-minded in that regard and certainly have our eyes focused on the same goal. And so time is of the essence. And we wanted to come out of the gate and really make a mark early and get in the game and compete. And so it's been a great run and it's been a bunch of fun doing it. I do think our partnership is unique in that regard, as you alluded to, but I think you'll start to see it more and more. As you start to scale, you do need that delineation of roles. And I can't think of a major firm that doesn't have an executive run business.
Yeah, exactly. And was it from the beginning, the vision to create this national enterprise that was going to be ideally a destination of choice for financial advisors? Or in the beginning, was it more, let's build a firm that's great for our clients where we can come together because we're friends and then we'll figure out the rest later?
I think in the very beginning, it was still under due diligence. I think when we made the decision to go the truly independent route and launch an enterprise of our own, we were all collectively there almost immediately as to, we just don't want this to be a local startup. We're looking to scale nationally and be competitive in the space. And we all look forward to it. We're all driven the same way from a competitive standpoint. And I think it actually resonated with everybody quickly. I can't remember during the process exactly what the responses were to the different ideas, but collectively, I can tell you we all had our eye on that same goal, which was let's become a national platform firm as fast as possible.
Amazing. So I'm curious, I mean, a lot of Wells Fargo advisor teams, the W-2 platform at Wells, they moved to Finet, which is an independent broker-dealer under Wells Fargo. It's popular because you don't really have to repaper, keep the account numbers, no one's poaching your clients if you leave, and it's familiar. It's the easy path, if you will. So how come you didn't attempt to build this enterprise under Finet? Or what was it about the setup within Wells or Finet that led you to want to take the biggest leap of all, which was to go fully independent?
I think for us, it was about how you define independence. Finet's an IBD, it's a captive model. There's still centralized compliance, certain product set, potentially what we would think is restrictions around what can be done for the client. And look, there are plenty of successful teams at Finet, many of whom we consider friends today. But for us, it was more about being a fiduciary, being truly independent, where we own our ADV, all the economics, and we've eliminated as many conflicts as possible from the firm-client relationship. So there are lots of models out there, not just Finet. There's a lot of IBD models and corporate RIA models. But for us, we really wanted to do the pure independence route, which we considered the route we went. And I think there what you get is the major difference for us as we looked at the different models. In corporate run models, you're allowed to do certain things. You're a professional seller of what's on the platform. And on our side, in the truly independent space, we put the street in competition for our clients. So we become professional buyers versus sellers on behalf of the clients. And for us, that seemed very important to us. And so it eliminated a lot of the competitive setups that are out in the marketplace.
My assumption is that most advisors who move from Wells Fargo advisors, private client group to Wells Fargo Finet, the independent side, like, I think they would be interested in what you said, right? Like, who wouldn't want more autonomy to eliminate conflicts, et cetera? I think the challenges for many is they either don't have the energy to go through a full repaper, and to them, independence is good enough if it means I'm a 1099 and I have better economics. So with your team of founders, it seems like the easy path was there, but it was more valuable to you, and you all valued more the autonomy and different benefits to clients, even though it would have been probably quicker, less brain damage, probably cheaper, less risk to make the move to Finet. Does that seem right?
Yeah, I think that's a fair assessment. I do think where you started there was it's about how you define that independence. And for us, that definition was all the way down the road of the economics, the ADV, et cetera. So I would agree with that.
What was your process like? You mentioned some of the things that led you to the RIA model and running your own RIA, but curious, just what was the process like? What types of firms did you look at, and how ultimately did you land, not just on the RIA model, but opting to partner with Dynasty Financial Partners as your platform provider and overall support partner?
We were doing due diligence separately, and then collectively we came together. When you talk about the opportunities that were explored, I think part of it for us was the education in the space. And so we explored everything from traditional competitors all the way through, as you mentioned, the IBD models, the corporate RIA models, the hybrid models, the regionals, and then pure independence. And so that process was enlightening. It was educational, and it really helped form and reinforce our beliefs. I think we often relate it to driving down a highway. There are exits on that highway that could be other banks or wirehouses. They could be regionals, IBDs, aggregators, whatever it is. But the very last exit on the highway is pure independence. And that's the exit that we decided to take. And now the idea was to have DayMark sit off that exit as a choice at the end of the exit ramp for elite teams that want that outcome, but maybe not necessarily to be alone. And so the due diligence process, as it often is, was educational. It reinforced a lot of what we believed. It changed some beliefs for us, and we feel like we left no stone unturned in it. And then the second part of that question, which was what led us to Dynasty, when you're making the leap to pure independence, and especially with the goals we had in mind relative to scaling the business, you have to make a decision on what you're going to build and what you're going to outsource. And in our opinion, at launch, outsourcing gave us the most leverage and allowed us to think about scaling the business immediately with Dynasty's support. You've got one shot to get the launch right, and we felt like they were the best in the business at supporting the launch, and specifically around our goals. They understood it, and clearly they're a leader in the space. So we had a desire to become highly professionalized RIA right out of the gate, and in our opinion, hiring Dynasty gave us a head start in that regard. They've been great partners. We're a client of theirs, so it's an interesting relationship, and we're thankful for it.
Yeah. So I think it's again another proof point of having the vision and being willing to invest in making it a reality. So we want to build a national enterprise. So hiring Mike Quin without a book of business, hiring and paying for Dynasty, and making other intentional decisions along the way enabled you to hit the ground running in building this, where perhaps if it was more of a lifestyle, or, hey, we're just a group of guys coming together who wants to make more money and have a larger exit at the end of the day, some of those decisions may not have been necessary. But given what you were trying to accomplish, obviously these decisions are expensive, but they're essential to be a platform where you can look someone in the eye and say, like, trust your business to us. Like, we got this covered. We've already invested in the company, and move your clients here and you're going to be successful. So again, I love the thought behind it. Like, of course, there's ways to be more profitable, but is it going to get you quicker and in the most efficient way to what your vision and goals are?
Yeah, I'd agree with that. Obviously, from our standpoint, I think the profitability conversation is interesting because our belief is that over a long period of time, our profitability will be greater due to the setup and the patience of building it correctly. And that comes through scale. And so when you have that vision, I think like any other business, you're willing to invest where you think you're going to get the most payoff for that. And that's what we've done. And that was part of the decision around Dynasty.
And I just want to unpack the last comment a little bit. I think I get it, but just to make sure, I'll repeat it back or paraphrase it. So by investing in the business the way you did, over time, that will allow you to gain scale because you'll have attracted other advisors. So once the business kind of reaches scale, or it's like the fixed costs can stay relatively the same, you'll begin picking up operating leverage. And then all of a sudden, the expenses or the investment you made in the business is suddenly worth it because now you're running at a more profitable clip because of the scale you've had. And basically, like, what comes first, the chicken or the egg? In your case, the chicken was investing in professional leadership, hiring Dynasty, and the egg is we're going to have a bigger business that's going to be more profitable.
I think that's a fair assessment. I think investments out of the gate are always done in an effort to reap the rewards down the road. And when running any P&L, the fixed costs eventually will plateau or at least expand per revenue dollar. And as they expand per revenue dollar, you actually get a hockey stick in profitability in the later stages of the startup phase.
Yep. Awesome. So Mike, something that has really stuck out to me is how successful DayMark has been in recruiting teams in a very quick period of time. And not just teams, but fairly large and sophisticated wirehouse teams. Most breakaways dream of doing this, but very few are successful. So can we spend a couple minutes just talking about your recruitment strategy?
Absolutely. Happy to do it. I think who we're attractive to is elite teams in the RIA space. And we start the conversation first around reviewing the benefits to the client. For these teams that have been in the business anywhere from 20 to 40 years, they've been around the block, they have an understanding of the business, and certainly have built generally successful platforms for their group. Starting with the benefits to the client and reviewing those benefits in the RIA space versus where they are is usually an eye-opener when they see our capabilities versus the captive environment they've been sitting in. And so once an elite advisor starts to understand that there is a different way to serve the client, that generally gets us into a deeper conversation about what all the other advantages and potential trade-offs are in a move like that. And so once we get through that part of the conversation, you can see the light bulb go off and we have a little deeper conversation around the rest of the model. And so from the economic standpoint, we feel like we've brought the private equity model to the individual advisor teams, but with a long-term partnership. As we're built for elite teams, I think that the possibility of being a business owner is appealing to the groups that join us because in some regards, they feel like they're doing it now, but unlocking the rest of the balance sheet and other side of the economics is important to them. So at the firm here, we believe a couple things. One is that it's their life's work. It's the financial advisor's life's work. And so while I think most firms are capitalizing on the financial advisor's life work for their business gain, certainly in a publicly traded company or in the wirehouse space that's driven by share price, you've got aggregators, strategics looking to increase firm valuations. But here we believe the primary beneficiary should be that elite team unlocking those economics, and we help them set that up.
How do you define elite team, and what's the thinking behind targeting elite teams where they're seemingly harder to get than trying to attract, let's say, more advisors who may not have as large a businesses?
We don't have a definition of who we seek for acquisition or partnership, but I do think in general, first of all, the partners that are with me here were all elite advisors in their own right with a lot of experience. And so sharing a common vision, sharing a common belief system is important. Culture is obviously hugely important when you're bringing in new talent. And so elite to us means professionals who've been doing it for a long time. If you had to generalize asset levels in that type of metric, $1 billion is probably our sweet spot. We look at 500 million and above to bring into the organization. And generally, there aren't a lot of them running around, to your point, out in the marketplace, but the ones who have done this for a very long time are always curious about what else or how else they can best service their clients. And as that becomes a little thinner space, or there's a little less opportunity maybe in that space, when you actually bring somebody into the fold and they become true partners, the economic payoff, I think, to both parties is worth the wait. And we don't want to be all things to all people. We're not all things to all people from an advisor standpoint. And I don't think that most of the successful firms are. I think that on this side of the business, we really have the luxury to concentrate and grow this under our belief system with like-minded individuals.
It's also call it like the Rockefeller effect. Rockefeller built a firm from the jump, that was going to be only for exclusive advisors, very specific, very intentional, and success becomes a flywheel. And if you attract elite teams from the start, you're putting out the bait or the breadcrumbs for another elite advisor to follow. Because typically advisors like to know that they're around people that are their peers, that match their skill set, match their commitment to the business, et cetera. So again, a very intentional decision that is paying off. Two more questions on the recruiting side. First one, just on some of the thinking around the economics. So not for you or your founding partner, it's a little bit different. But if I'm an advisor who is elite, $500 million, billion-dollar book of business, I can go to 50 different firms. Whether it's getting a deal from UBS or Morgan, it's going to Rockefeller, it's going and starting my own firm from scratch, trying to build the next DayMark. From an economic standpoint, what's the thinking or kind of way that you coach prospects and advisors that have joined you around why the financial opportunity is better within DayMark?
It's a good question. There is a lot of choice out there, and there clearly are successful models under multiple avenues of choice. I think here at DayMark, the economic structure is built around those advisors who want to be the business owners. And so when we take a look at a group to bring into DayMark Wealth Partners, we look at taking a minority stake on a markup multiple based on their free cash flow on this side of the business, and then create for them their own operating company on the DayMark platform. What that really does, Lewis, is it unlocks a multiple arbitrage for them immediately. So their business worth, whatever that multiple might be in the marketplace, at launch almost immediately becomes valued under our umbrella at our multiple. So you get some equity arbitrage, of which they own the majority of that equity in their operating company. And that really goes back to it's their life's work. We think that they should benefit from those economics. So I think it's different, relatively unique in the space. We're not wholesale buying them into the firm and distributing our equity to them versus helping them create their equity and then allowing them to participate in the platform and the partnership and potentially gain that multiple arbitrage on valuation and any type of exit.
That makes a ton of sense. It's like you get the best of both worlds, right? You still have your own upside from growing your business. You can still have a very lucrative liquidity event. So you're not selling out too early. And instead of just betting on yourself and your ability to keep growing, you get to reap the benefits of aggregation and being part of a partnership. So it makes a ton of sense. Models like this, not exactly the same as DayMark, are becoming more popular. The thought of coming together and having a larger exit than you could on your own. But certainly it's a big choice for an advisor, right? Taking the bet on DayMark versus a more known entity or safer entity like Morgan Stanley or Raymond James is a big leap in and of itself. And then having the mindset to think longer term instead of getting probably much more money up front from a traditional recruiting deal. Still getting money up front, which is, I think, important in this space, but getting less and betting on yourself and on the success of your new partners at DayMark. So it takes a certain type of person, but I understand completely why it's compelling to the right people.
Yeah, I think that's a fair assessment. There's a lot of different ways to look at the finances of the business, but I think that long-term ownership and value creation for the correct individual and the correct team, when you create that equity valuation or enterprise valuation over time versus taking an upfront check that's spread out at W-2 income over a period of whatever the term may be, 10 years or plus, it's a completely different model. And what we forget in all this is most elite teams, the advisors own the clients. And while they might not contractually own them, those clients have done business with them. That trust is built for multiple generations at this point. And those clients are going to take the lead of that advisor. So it's important. There are a lot of avenues that work for a lot of different teams. It's important that they find the one that they can really believe in and get behind. And their clients feel that and generally follow them to whatever the next phase is in their career.
Well said, Mike. Can you talk about an example or two of teams that partner with you and maybe just share briefly where they came from and what was it that kind of tipped the scales for them?
Sure. Two teams come to mind off the top of my head that are in the network now, and they've joined DayMark Wealth Partners over the last 12 months or so. The first would be a group called the Compass Group of DayMark Wealth Partners out of Pepper Pike, Ohio. That's the east side of Cleveland. They have over $1 billion in assets under management, longtime pros, sharing the same beliefs around serving clients. I think the attraction for that particular group was based on wanting to be able to reap the benefits of being a business owner, both from a setup standpoint, a tax efficient income standpoint, but wanting to have a partner to help them do that. I think that they really like the end result, but getting there was a pretty big mountain to climb. So I think that's the first group. And in addition to that, they understand the power of scale. It's a big business in and of itself at over $1 billion, but scale can only help that valuation. And then I think the second group, we've got a group which joined us in May in Southport, Connecticut called the Hofstetter Barron Group of DayMark Wealth Partners. They run over $500 million. Their driver was about how can they best serve the clients as an owner without conflicts from their firm. And so they spent a lot of time in due diligence around the client outcomes and what could be created. And then certainly understanding the economics and wanting to gain control over the other 50% of the economics in their own P&L was attractive to them. So two different walks of geography, two different places in the country, similar beliefs and interests, but I think they dove in and really dug in the due diligence in a couple different ways.
That's very helpful, is to make it more tangible. And any tips for anyone who's listening who wants to recruit advisors? I'm not asking you to give your secret sauce, but what does it take to be able to attract teams like the ones you have?
Well, I don't think there's a secret sauce. It's not easy, but I think first it has to be about them and not you. Listening is a skill that oftentimes we overlook, but listening to what they are trying to accomplish and helping them solve for that in the context of your firm's strengths really perpetuates the conversation into multiple levels from there. And sometimes it's not a fit, and that's okay. I think being open and honest with the person who's doing the due diligence, they're out in a space where they're trying to learn. And so helping them learn by first listening to where they want to go and working on the education piece is important. They're highly successful financial advisors, but this is their life's work and it's a big risk. And I think acting as a partner from the very beginning will help get some groups across the finish line.
I love what you said. It's about them, not about you, and to listen. I mean, that's the core belief of our company. And I think part of our success in developing relationships with advisors, it also seems like it can be directly applicable to how advisors can attract clients, right? It has to be about the other person. Like, no one really cares who you are necessarily. It's a big decision. So you have to figure out how to position what you're good at in the context of their needs. That's brilliant stuff. Thanks for sharing that. Real quick, I just wanted to ask you about a firm that's getting a lot of recent headlines and launched around a similar time as DayMark and Partners, which is run by ex-Wells leadership. They've had a lot of success in recruiting advisors from Wells and other firms. They offer equity, and it seems to be about building something for the long term. So I'm just curious about your thoughts on them or competitors like them in the marketplace.
Sure. Happy to chime in on And Partners. First, David and John are friends of mine, as is most of the team they've assembled at And Partners. So I think it's great to see them out in the marketplace having success. Their model is completely different than ours, which just reinforces the fact that there is choice for everybody out there. And there's demand for both, and certainly much more. So yeah, my reaction to what they've done is good for them, and we wish them nothing but success.
Yeah, there's plenty of advisors to go around for everyone. It's not about competing. It's about figuring out how your firm is different and understanding the profile that's going to be attracted to you. And it's good for the advisor that there's all these different options. It shouldn't be looked at as competition. It validates that this is a segment of the market that has real life to it. And the more firms that come up, whether it's DayMark or And Partners or fill in the blank, it just means that advisors can pick and choose their own destination and may not have to build something on their own if they're not geared that way.
Yeah, I'd agree with that 100%. And so would the partners here. I think that, as I mentioned, we know David, we know John, we're friends with them. I think having known entities out in this space, especially, and you've mentioned some firms before that we've worked with at former firms, it's good to have choice, and thinking abundantly is not a bad thing. I think that there's plenty of business to go around. And the most important thing is having these advisors who spent their lives serving these clients land at the right firm for them and their beliefs.
No doubt. So now that you're more than 2 years into life as a CEO and an independent business owner, what are two surprises? Let's say one negative and one positive.
Well, I think first, the impact of the power of ownership is not lost on our group. I think that we have a firm here where at DayMark Wealth Partners, everybody has equity in the firm. And so we're all owner operators. And so the power of ownership has been a big positive and a little bit surprising. The flip side of that is it's incredibly challenging and rewarding both to own the business. So that would be the negative. It's incredibly challenging and rewarding. I think you can almost answer both questions with the same answer.
And to make it a little bit more specific, how and why does the power of ownership matter? And then what are some things that are challenging about owning a business?
Well, I think the powership of ownership is an interesting question. My belief over the last 25 years or so is you can tell immediately who's an owner and who's a renter. And acting as an owner over the course of a career will build some significant relationships and equity in whatever you're doing and wherever you're doing it. But have DCRs here in our firm, and that's their directors of client relations, and giving them equity in the firm really, while they all may have acted like owners previously, having them actually own a piece of the firm is both rewarding to them, but drives home what we're trying to accomplish together. And it really brings the team together around common goals and allows us to accelerate the growth pattern. And I think you work hard when you're an owner, and it's a small business. And that can be, flipping over to the second part of that question, that's very much a positive, but it can be viewed as a negative if you're on call 24/7 and you get done what needs to be done for the success of the company.
So this extra responsibilities, which is not surprising to anyone, but it's ultimately rewarding. A couple more questions here. So private equity, probably talk about it in some context on every episode, is all over the space. And my guess is one of the reasons you and your partners launched DayMark was to one day build something that you can maximize the value of the business. Doesn't mean selling to the top bidder or being greedy, but having the optionality to sell the business or sell a piece of the business to either fuel growth or as a retirement strategy. How do you think about the future of DayMark and remaining truly founder owned versus bringing in private equity or institutional capital or even selling the business one day?
Yeah, it's a good question. And to your point, private equity is all over the space. So it is a topic that I think every firm discusses at some point. The way we think about it in terms of DayMark versus the partners of DayMark is, as I mentioned, we see ourselves as a platform firm with a lot of growth ahead of us. We're already diversified from a next-gen standpoint. So for us to bring in an outside partner into the table, we'd be looking for patient capital, somebody who's interested in accelerating growth, but it's really important for the founding partners to remain true to the culture and the founding principles. And so therefore, there's that control piece in the cap table that is still attractive to us. So I think that it's interesting to have those thoughts and discussions, but like when we launched the firm, we're pretty clear on where we're going. So if we ever get to a point where we're looking for a partner in the business, it would be long-term patient capital that understands where we want to go and then can help us get there faster.
I like that. I mean, some people if I asked that question, they would sidestep it. We're always going to be 100% founder owned. But I think, again, back to a theme of the episode, which is building the business with intentionality and basically investing in different ways to build a bigger business down the line. I think that's how private equity or some sort of outside capital can have an impact on a business like yours. As long as you can keep the elements of control that matter, you're finding the right partner, it's a way to add fuel to the fire. If you think you have this amazing scalable platform, it's expensive to keep scaling it. It's expensive to buy stakes in teams. It's expensive to hire the team. It's expensive to open up new offices. So looking at outside capital, not as an adversary or as like a cop-out, but more so as an accelerant for everything that you're doing.
I'd agree with all that. I think that upon launch, you can certainly do whatever you'd like, but we intentionally did it this way. We do have our own capital in the growth right now, and that's building equity, obviously. But I don't look at bringing in another partner as any type of cop-out. I would certainly look at it as a opportunity to accelerate what we're doing. And certainly, this RIA space is scaling quickly, and to be competitive, I think capital is important. But to your point, I think control and staying true to where you want to go as a business is important too. So as long as it's done for the right reasons, with the right covenants set up, I think it can be advantageous.
No doubt. Two more quick questions, and then we'll let you get on with your busy day. With some hindsight, what would you do differently over the last few years or even during the transition?
Lewis, you know the answer to that.
Everything?
No. We would have done it earlier, of course. Now, I think looking back, when you get to the point where we are as a firm, there are certainly things you could have done differently, and you learn as you go out into a new space. But I think that the resounding answer, if all the partners were sitting on this call and you asked that question, is the one thing we would do differently is we would have done it sooner. That said, that's an easy answer, but I think the space has matured quite a bit over the last decade, and we feel fortunate to have the history we have at all the different firms we were at, but I don't think we'd change much moving forward.
Good answer. Last question. Any parting words of advice for those thinking about change or just curious about the industry?
I think to be good at your craft, you need to be a steward of the industry that you're in. And so I think that it's positive to be curious. Your life, your career, it's a journey, and we think about it that way. Exploring and learning doesn't mean that there's necessarily anything to do or you have to do anything. It may just validate that you're in the right place and may make you better and understand the competition better. So my encouragement would be, if you're curious, get out there and learn. There are a lot of professionals out there to help you do that. You guys are certainly at the top of that list. Most of the elite teams we work with never stop learning and trying to get better and get that next gear. And I think that being curious about the industry and change is part of that process.
Another great answer. I think after you guys sell DayMark one day for many billions of dollars, you got an open seat at Diamond Consultants, because I think we're very aligned in how we think about things.
Well, I appreciate that. Maybe we'll take you up on that someday, Lewis.
There we go. Mike, but thank you so much for investing some time to share the DayMark story. What some of my big takeaways were just building this business with intentionality, some of the expensive but worthwhile investments that the firm made, and having the vision and stopping at nothing to achieve it, I think is huge. And I love what you said about the power of ownership, and also how you think one day about bringing in an outside partner. So I learned a lot. Hope our audience did too. And we'll have to do this again in a couple of years when it's a $20 billion company.
Well, I appreciate the time, Lewis. Thanks for the invitation on. Always a pleasure.
You got it.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.